With the U.S. as it reportedly orders Chinese airlines to stop taking deliveries of Boeing planes and to not buy the aircraft-related equipment from American companies.
U.S. President Donald Trump has remained firm that China must be first to step up to the negotiating table on tariffs. Beijing has reportedly blocked further deliveries of Boeing jets in retaliation to Washington, D.C.
The ongoing trade tensions between the United States and China have now found a new and volatile battleground: civil aviation. One of the most visible casualties of this growing rift is Boeing, the American aerospace titan, which has been thrust into turmoil following a bold directive from China's Civil Aviation Administration, a suspension of all Boeing jet deliveries. This single move sent shockwaves through the stock market, causing Boeing shares to plummet by nearly 10% within days, and laying bare the vast reach and lasting implications of the trade war between these two global powerhouses. This conflict, however, is far from a narrow squabble between governments or companies. It is a high-stakes clash reverberating through international supply chains, jeopardizing thousands of jobs and threatening billions of dollars in economic value. To understand the true depth of this crisis, let's examine the unfolding aviation standoff through the lens of hard numbers. As of the end of last year, Boeing's global order book stood at approximately 4,500 aircraft. Of these, more than 1,200 were tied to Chinese airlines and leasing companies, representing around 26 to 28% of Boeing's total global orders. The average list price of a Boeing wide-body aircraft hovers near $300 million, while single-aisle models are priced around $110 million. Though real sale prices often fall below these list figures after negotiations, experts estimate that sales to China alone account for $10 to $12 billion of Boeing's annual revenue. With long-term maintenance and parts agreements factored in, the stakes grow even higher. The recent suspension threatens to erase that crucial revenue stream. Early market reactions were swift and severe, wiping billions from Boeing's market capitalization. Investors worry that China's pivot could benefit European rival Airbus or accelerate China's own aircraft manufacturing efforts through companies like COMAC. For context, in 2024, China placed aviation orders worth approximately $14.5 billion, split between Boeing and Airbus. Should Beijing shift its full support to Airbus or prioritize domestic production, Boeing's slice could shrink to just $5 to $6 billion annually. Market analysts predict that such a loss could erode Boeing's market value by up to $40 billion in the long term, an outlook that explains the alarm seen in financial markets. But the impact is not confined to Boeing alone. Civil aviation exports are a linchpin of the U.S. economy, helping to reduce its trade deficit. The country exports around $130 to $140 billion annually in aviation-related products, of which China accounts for roughly 15 to 18%. Losing that share would mark a devastating blow to U.S. trade figures. Boeing's supply chain spans across nearly all 50 states. Thousands of small and mid-sized firms, producing everything from engines to avionics, seats to landing gear, feed into production of each aircraft. A halt in Chinese deliveries threatens this intricate web, with some forecasts suggesting that engine component manufacturers alone may cut 5,000 to 10,000 jobs by the end of 2025. On China's side, phasing out Boeing is no small feat. Chinese carriers rely heavily on Boeing models like the 777, 787, and 737 MAX for international routes. Transitioning to Airbus or domestic alternatives will require extensive pilot retraining, infrastructure overhauls, and months-long adaptation periods, not to mention significant new costs. Nevertheless, China seems willing to endure short-term difficulties to exert maximum pressure on the U.S., wagering that Washington will suffer more. This lose-lose strategy reflects the hardened posture of both governments. The U.S. has slapped tariffs of 25 to 50% on certain Chinese tech and industrial goods, with threats of more to come. In retaliation, China has placed restrictions on U.S. agricultural and energy products, and most recently, on short-range passenger aircraft. Boeing now finds itself at the epicenter of this retaliatory storm. Previously, Boeing's deals with China had a total potential value exceeding $150 to $160 billion. If this commercial volume is redirected to Airbus or others, Boeing faces a prolonged revenue drought. Within just a week of China's delivery halt, Boeing's market value has already shrunk by $15 to $20 billion. The company, still reeling from the $20 billion setback caused by 737 MAX issues during the pandemic, now faces fresh uncertainty. Analysts warn that a 6 to 12-month freeze from China could slash Boeing's delivery revenues by as much as 25%. Boeing employs around 140,000 people globally, with 30,000 dedicated to commercial aircraft production. A mere 1% dip in profit margins could place thousands of those jobs at risk. What began as economic protectionism now threatens to become a self-inflicted wound on the American labor force. In public comments, former President Trump blamed China for withdrawing from the Boeing deal, accusing it of damaging American interests with unfair trade practices and currency manipulation. These remarks suggest that the U.S. administration remains steadfast in its approach, despite the cost of domestic industries. There is growing speculation that Airbus may soon announce a major new deal with China, potentially involving 150 aircraft. Should that happen, it could signify the final unraveling of Boeing's position in the Chinese market, a nightmare scenario for the American firm. According to Chinese media, Boeing's aircraft sales to China over the past 5 years exceeded $50 billion. Looking ahead, Chinese carriers plan to acquire over 500 new aircraft within the next decade. Each delivery brings Boeing hundreds of millions in revenue when paired with service agreements. Losing this future business would leave a massive void. Even though Airbus and COMAC, with projects like the C919 and CR929, are expected to fill some of the gap, these replacements are not yet fully capable of meeting China's near-term needs. Still, Beijing seems determined to teach Boeing a lesson, even at its own expense. Boeing, for its part, sees the move as a clear act of political retaliation. Company lobbyists warn Congress that without a strategic pivot, Boeing could be locked out of the Chinese market for the next 30 years. While some in Congress urge tariff flexibility to safeguard Boeing, the Trump administration appears resolute. This is about strategic consistency, not compromise. As a result, Boeing is bearing the cost of a much broader geopolitical standoff. In 2024, Boeing earned $7.4 billion from Chinese deliveries, and projections for 2025 had expected $9 to $10 billion. Now, that figure might plummet to near zero. Experts believe the fallout may soon spread beyond aviation. Should China expand retaliation to other sectors, like semiconductors, agriculture, or chemicals, U.S. exports could suffer further, heightening the threat of a global recession. Today, Boeing stands as a symbol of the rising strain between the world's two largest economies. What was once a protected sector has now become a geopolitical weapon. In numerical terms, this crisis puts $10 to $12 billion in annual revenue at immediate risk, imperils long-term deals worth over $150 billion, and threatens a $50 billion erosion in market value. While some hope diplomacy might eventually rescue Boeing, perhaps through behind-the-scenes talks or special exceptions, it remains uncertain whether either side is willing to compromise. Until that changes, companies, supply chains, and workers on both sides remain in limbo.